What are the basic trade-offs between a weak domestic currency and a strong domestic currency? The US dollar was down 10% in 2025. It has huge implications for what that means for the US economy. We'll start with the stronger US dollar because that's been the long-term trend. The upside is that it leads to lower import prices. So let's say I'm a US importer and the current exchange rate is 1 USD for 1 euro. I, as the US importer, am importing a car part that costs 1 euro. I would exchange 1 USD for 1 euro and purchase the part. However, now we introduced a new exchange rate. 1 US dollar is now worth 2 euros. So with that same US dollar, I only have to exchange a half of a US dollar or 50 cents for 1 euro and purchase the part. Because the US dollar strengthened, I can now import the one part that I need cheaper than I could before. But there's a trade-off. A stronger dollar is going to lead to less competitive exports. Scenario 2. This time we are the exporter. So the USD strengthens against the euro. 1 USD is now worth 2 euro. Now they have to exchange 2 euros for 1 USD and purchase the part. So what can happen now, if this is a product that can be produced elsewhere, let's say for 1.2 euros, instead of continuing to work with the US importer, they might look for a different solution instead of having to pay the 2 euros. Higher USD equals lower import prices equals happy consumer. And then on the flip side, lower USD equals more competitive exports equals happy manufacturers.